Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, August 24th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you individual investment advice. Anything that you see here or hear here is for informational purposes only. Please do your own due diligence. It's your money. It's your responsibility. Okay, so the big news for the week was the much anticipated conference call, earnings call, and update, production update by Kazatomprom, and it wasn't good. So this is actually bullish. It's not, it's actually even, I think, still even bullish for Kazatomprom, but regardless, you know, just to summarize, we have been and continue to be in a supply demand deficit for uranium. This in the context of demand increasing as the world now has fully embraced nuclear power as a solution to the electrification, climate change goals, and just general benefit of producing electricity. And so Kazatomprom being the world's largest producer, akin to, analogous to, if you will, to being the Saudi Arabia of uranium, basically slashed production guidance for 2025. So it's the same old story. I think it was pretty significant news. Uranium stocks rallied hard yesterday, and I expect that this could be the catalyst for a new move higher in uranium prices, the next resumption of the bull market. You know, we've kind of been in the summer doldrums. People have been on vacation. This is not a market, as I've pointed out before, that's like open outcry, like at the NYMEX or whatever. I mean, although they don't have that anymore. It's not like the Chicago Board of Trade or the NYMEX where, um, you know, there's all of these traders and all this liquidity, and news is digested immediately and reflected in prices in seconds. Okay. You know, if Saudi Arabia came out and said, we're not going to meet our production guidance, it's falling by 17% next year, you know, oil would probably go to $200 a barrel immediately. So again, just to remind everyone, this is a very opaque market. There's some small players. I've heard Cuppy say that, you know, he gets texts from these guys. I know that Michael Alkin said the same thing. These people actually buy physical uranium, and it's maybe 10 total entities that trade uranium among themselves. So again, that's in a spot market. We're more concerned about the term market, right, where contracts are being signed. The reason I'm saying that I'm getting more bullish, obviously this is a big deal because we already had an existing supply deficit, which is now going to be exacerbated. But we also have I think it's a WNA conference coming up September 4th through 6th. And I'm quite sure this is when all the nuclear players will be together, right? Fuel buyers, utilities, mining companies, hedge funds. Cuppy talked about going to it, you know, last year. I think it was last year or the year before. And so I think there's going to be like, you know, is this going to be the wake up call for people and say, oh boy, this is a problem? So we'll see. Uh, I'm bullish on, I've never changed my bullish stance on uranium. I mean, it's a long-term bull market, and you have to be willing to ride through, unless you're some expert trader, which I am not. I've admitted that freely. Most people are not. Uh, my suggestion is buy on dips and just, you know, accumulate when news is bad and prices come down. And, you know, I think you'll be richly rewarded as this plays out over the next several years. But this is very bullish news, in my opinion. So this is from the FT Financial Times. Quick couple of blurbs. Kazatomprom slashes production guidance. Kazatomprom, the world's largest uranium producer, has slashed its production target for 2025 due to project delays and sulfuric acid shortages, threatening to squeeze supplies of the radioactive fuel vital for nuclear power. The Kazakh company, which generates a fifth of global uranium supply, I think it's actually higher than that. I think it's much higher than that. But anyway, cut its target for next year by 17% to a range of 25,000 to 26,500 tons of yellow cake. I think it was originally 30 to 31,000 tons, something like that. And then you have a comment by Nick Lawson of Ocean Wall, which is he's pretty Ocean Wall's really been good on uranium analysis. I like listening to him. And he has an understudy over there. I forget the guy's name. It's pretty good. But anyways, quote, "This is a structural problem. They cannot ramp up," said Nick Lawson, chief executive of Ocean Wall, an investment house that is bullish on uranium. Quote, "It won't just be the West saying this is an issue for us. It will also be Russia and China saying it's a problem for our new nuclear power plants," unquote. So I think that there could be and should be, whether it happens or not, I don't know, a re-rating higher of companies that are existing producers, okay? Because they actually have uranium and can sell it, right? And so, you see a lot of the brownfield projects. Sprott, I think, had a chart recently or an analysis. I'll have it in the weekly free email, which is subscribed to in the show notes, showing all the existing brownfield plants, brownfield projects people are trying to bring back online. What's a brownfield project? It's an existing project that was shuttered due to low prices that companies are trying to bring back on. A new mine. It's not a new mine. It's an existing mine that was shut down that they're rehabilitating and bringing on. And so that'll bring on some incremental supply. But I think the companies that have that are kind of in the cuckoo bird seat. You should take a look at those because, again, I don't see anybody committing billions of dollars to build greenfield. Greenfield means new uranium mines. The only project I see is Dasa in Niger, and it's plagued with a bunch of problems with the coup and some financing issues. So this is a big deal because without, this is kind of the musical chairs scenario now starting to develop that I thought might happen. I'm not saying, I can't know the future 100%, but when everybody goes to this conference early next month, which is in a couple weeks, and people were just being sanguine, or just sitting on their laurels and not paying attention to this uranium market, is there going to be enough uranium for everybody? I can guarantee that the Chinese and Russians are going to be out there. As a matter of fact, I think another part of what I read in the report from some reports from other folks was a large amount of the new production that is coming out of Kazakhstan is going straight to China and Russia. So this is a problem. And, we could see, again, people have said, and I've said, that we're going to need way higher uranium prices to really bring those billions of dollars of new mines or investment for new mines to come online. So I suggest that, this could be a catalyst, for higher prices. We'll see. This is a big deal. So here's John Quakes. There she blows. World's largest uranium producer, Kazatomprom, announces first half 2024 financial results and slashes 2025 production guidance by 13.65 million pounds from midpoint 31,000 tons to 25,750 tons, a 17% cut. Much of that cut is attributed to a more than 65% reduction for the Russian Budanovsky joint venture. Continuing uncertainty around sulfuric acid supplies for 2025 has significantly impacted production plans. The other thing that they did say, if you go and read the corporate update and actually read it, the company will not give 2026 guidance right now. They said they will wait till 2025, this time in 2025, to give 2026 guidance. This company is having major problems in management. As a matter of fact, the CFO, who's only been in his post for 11 months, also resigned. So this company has major problems, okay, in management. I mean, they have good assets, or they have had, so there's something going on there with Kazatomprom. Poor management, problems with sulfuric acid, construction delays. I told you mining's a tough business. And so this is where you're at. And this chronic underinvestment now is culminating. We're getting to a culmination point here that's extremely bullish in my view. If you spend $2, $3, $4, $6 billion, what have you, on a nuclear power plant and don't have the fuel, this is a problem. And we could be approaching that. Is this going to derail possibly the nuclear renaissance? I mean, these questions are going to start coming to a head. Now, this happened on Friday. People are going to be digesting the news and then meeting at this conference in 2 weeks where all of the industry gets together. I guarantee you this is going to be a major discussion point. So here's in the commentary from the companies, says there's a highlight that John Quake's made. If you're not following him and you're interested in nuclear, he's pretty good to follow. He's like the Action News of the uranium market. I mean, if you put him on your Twitter, if you follow his Twitter feed, you will get up to date with any kind of news, no matter how prominent or obscure in the uranium sector. It's a good person to follow. It's highlighted here. The company is now, well, we talked about adjusting the supply, 25 production. Okay, significant portion is attributed to the Budanovsky production delays. Continuing uncertainty in relation to sulfuric acid has significantly impacted the company's production. And here they say here, taking into consideration high level of uncertainty related to the sulfuric acid supply and construction delay challenges, no decision has been taken regarding mine development activity and production volumes for 2026 and beyond. Wow, this is probably the most, this could be the catalyst that would be similar to the mine flooding that happened at the Cameco mine in the last bull market. The difference is in the last bull market, we didn't have, 40 million pound deficit in supply. Okay. And we didn't have a situation where everybody was building nuclear power plants. So this could be the catalyst to launch this thing into geosynchronous orbit. Again, I'm not trying to get overexcited. I'm not trying to pump it. It is what it is. This is what we always thought would be a catalyst, right? And we understood as it became more and more clear that Kazatomprom, the original thesis killer, the bear argument on uranium going back a couple of years was, well, Kazatomprom is going to flood the market. As soon as prices go up, they're going to flood the market with so much uranium that the price will crash. Okay, well, that particular canard was put to bed a couple of years ago. And now you're in a situation where the company's struggling to increase production, okay? And we're hearing the same excuses: sulfuric acid supplies, construction delays, management in disarray. This is very bullish if you are a company that is able to increase production in an environment where supply is going to continue to be constrained. And I don't know what's going to happen, obviously the future, but I think this is tremendously bullish. I haven't sold anything, and I find it amusing now. We'll see how sentiment changes now on Twitter, or uranium Twitter, if you would, urane twit, whatever you want to call it, and see now that we have another shiny object going in front of the fish, if they'll start chasing it again, and we'll get all this, I think sentiment's really bombed out though, because people are like, still, you're seeing, I've gotten, people are like, well, hopefully this happens. I'm cautiously optimistic. I mean, this is a big deal, guys. You can't, like I said, this would be like Saudi Arabia. What would happen to the oil price if on Monday, Saudi Arabia said, we're going to slash production by 17%, or our fields, we're in disarray and we can't, our production's going to go down 17%. Like I said, oil prices would go to $200 a barrel immediately, or something crazy like that, because the supply demand is so has to remain in balance. And if you were to reduce Saudi's oil supply by, a couple million barrels a day, that would affect world markets. This is the largest producer saying that production is going to be down 17% from the previous guidance. This is tremendous. So this was a Barron's article. Jeff Curie, I believe he used to be the commodity analyst at Goldman Sachs, I believe. I'm not sure. One of the big firms. I think he's off on his own now. He retired. But they're talking about this commodity super cycle that he's been talking about. Others have talked about. I don't know if he came up with this. This is also what I've heard other people say this too. We call it the quote, what he said in the article in Barron's, we call it the revenge of the old economy. Bob Robotti has said something similar. That's why he buys a lot of these cyclical stocks, because it's the revenge of the old economy. Sectors that have been underinvested in, and now they're in the, they've consolidated. There's just a few players left, and this is the ability for them to generate tremendous cash flows. As again, if you don't grow it or mine it, you don't have it. So here's some quotes from the Barron's article. Let's step back. This is a question from Barron's. You have been bullish on commodities for a few years. You even talked about the idea of a commodities super cycle that could lift metals such as copper and oil too. What does a super cycle mean in this context? And then Curie answers, it's a capital expenditure cycle. We call it the revenge of the old economy. And then Barron's editor or reporter, meaning metals and energy, and that spending on old economy commodities starts to rise. Curry, yeah, it has happened before. It happened in the 60s. After World War II, there was a global capex boom. We built up everything. By the late 1950s and early 60s, we were swimming in overcapacity. Inflation went down to very low levels, interest rates were cut, and the equity market ripped. The hot investing themes in the 60s was the nifty 50 consumer brands such as Coca-Cola and Gillette. Then what happened? It was the revenge of the old economy. The country hadn't kept investing in all the non-financial physical stuff. Exxon was a terrible stock during that time period. A demand shock occurred when President Lyndon Johnson's Great Society Initiative and old economy companies and stocks were off to the races. There is a close analogy to today. The Organization of Petroleum Exporting Countries took advantage of that situation, just as Russia has taken advantage today. It happened in the 1990s too. We had low and stable inflation, low interest rates, and the market chased long duration stocks of companies expected to pay out most of their cash flow far in the future. I'm talking about tech stocks. It was the dot-com era. And then again, the old economy stocks came back to life. The demand shock that time was the rise of China. And so, end of Barron's discussion. So my commentary is very simple. Mineral and oil and gas extraction, these things are extractive industries. They are depleting assets. You have to find more in order to stay in business. Every barrel that you pump out of the ground, if you don't replace it, at some point in the future, you'll go out of business. And so people have underinvested over the last 10, 12, 15 years in these old economy type stocks and businesses. And so now, people are saying, well, China is the biggest consumer of commodities and it's in recession. And so this is going to derail higher prices. And my pushback is, what about India with 1.4 billion people? The place is on fire economically, and it's sucking in commodities now. Not at the same rate as China, but it's growing. Then you'd have to take into account the rest of the emerging markets, the rest of the frontier markets, okay? They're all trying to do the same thing, industrializing, urbanizing, raising standards of living requires huge energy and metals inputs. That is where the super cycle is coming from. You put that in the context of a period of extreme underinvestment, and it's going to collide and result in higher prices. That's the thesis. So we'll see it's not something that, well, on Monday I go out and buy, and then over the next couple of weeks I'm going to make money. This is a decade-long situation that you can expect. Again, I've said this before. When this is over, you will look back at the chart and you will see that it has went over a decade or more period from the lower left to the upper right. But there will be periods in that secular long-term bull market where there will be cyclical declines because of recessions or what have you, different things that happen. Nothing goes straight up, nothing goes straight down. So just be aware of that. There will be some volatility. But I think that if you understand the supply-demand dynamics of the various resources, and then you do some work to find out where the best managements, the best projects, you're going to be able to I think, outperform the general market. So we also had the Jackson Hole economic deal that the Fed has every year, and some remarks from Jerome Powell. Basically, the main comment is money, the last bazooka now is now loaded and ready to fire starting on September 18th. I talk about the monetary bazookas, major central banks. Again, we have basically most of the world's central banks now in rate cutting modes. We were waiting for all of the developed market economy central banks, which I call the bazookas, to start firing, okay, for the next liquidity cycle. And now the Fed is now one of the last. They were one of the last to raise, so consequently, they've been one of the last to start their rate cutting cycle. But it's in the bag now. It's guaranteed. We're going there. So here's what Powell said, quote, "The time has come for policy to adjust." He's talking about interest rate policy. "The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the unbound risks," unquote. He went on to say, I got a couple blurbs here that I got off Twitter. Somebody analyzed it. Quote, "Fed will do everything," unquote, "to support a strong labor market. Fed does not welcome further weakening of the labor market. The way labor market's weakening, I suspect, we're probably already in a recession. Obviously, in manufacturing, we've been in a recession. Spending slowing down. We'll see what happens. I've read different commentaries where some folks think the recession will be mild just because the fiscal spending continues. Both of these candidates for president are populists and will spend money. So maybe, but the debt there is there also, and the interest payments are there also. So we'll have to see. Going on here with the bullet points, confidence has grown that inflation is heading to 2%. Well, we'll see about that. Balance of risk to Fed mandates has changed. Inflation has declined significantly toward the goal. The Fed pivot, I put this in here. The Fed pivot is officially here. We just don't know the magnitude of how much they're going to cut rates. Again, I want to remind you, I think that over this rate cutting cycle, this will be bullish for hard assets. It should be bearish for the dollar. It should be bullish for emerging markets. Okay, but in the short term, I suspect it's going to be negative for the stock market. We have shown this over and over, and I've warned you. Okay, the Fed is not cutting. They're cutting rates because the labor market's softening and we're probably in recession. When the Fed does that, historically, the stock market goes down. So you need to prepare yourself for a stock market decline. I'm not saying it's going to crash, but I'm saying that the market's probably, you're going to have a drawdown in the market. Because why? Because they're cutting rates because there's a recession, and in a recession, profits go down. Okay, so multiples will go down and stock prices will go down. Now, conversely, this is going to be very bullish for resources, for gold. Bitcoin, I think, is back over 60,000. So I think that's that's a liquidity basically driven situation. So these things are now starting to front run or sniff out what the Fed's going to do. And so now the conversation will shift from, are they going to cut, to, yeah, we're at 64,000 today on Bitcoin. Gold's above 2,500 and holding there, probably going to be moving higher. And so I think that we're positioned properly. I have cash on the sidelines. I've talked about what I'm doing with it. I'm prepared to see what happens and look for opportunities. I will tell you that I was back in the market on Friday buying uranium stocks that I like. And I'll probably be adding a new one to the portfolio that I really started liking a lot. But regardless, I still think there's opportunities. Now, again, if you're in tech stocks, what are you going to do when NVIDIA goes from a market cap of, whatever it is now, 2 to 3 trillion to 500 billion, and it's going to happen. Okay. what are you going to do if you're holding that stock? We've seen this happen before. Okay. The probabilities are that the market's going to go down, not up. Initially, stocks reacted well. Maybe this time's different. I don't know. But the market's already overvalued. And again, they're not cutting rates. They're cutting rates because they see economic weakness as illustrated in the labor market. And that means recessionary conditions, lower profits. Now, it's not in the bag. Maybe, like I said, I've listened to some podcasts with some guys that I respect that are macro guys that said this might be a mild recession. And so you may not see a bigger decline. But historically, when they're cutting rates because of recessionary conditions, you typically see a 30 to 50% drawdown. But we'll see. Here's a Bank of America Global Fund Manager Survey. You've almost got 100% of fund managers now expecting lower short-term rates in the next 12 months. If you're in cash, you may want to lock in your CDs for 6 months to a year, or your T-bills, what have you, because as they cut rates, you're going to see short-term rates come down, and you're going to have to make some decisions. This is what I'm talking about. This is an interesting divergence. Something to think about based on my prior comments about weakening, about recession and weakening profits. It says percent of S&P companies citing recession on earnings calls. So, they have earnings calls, and I guess they have AI listening, and how many times the word recession was mentioned on an earnings call. And you see for the last quarter, out of the 500 S&P companies, only 28 were talking about that. So maybe, last quarter was only 27. So maybe it's, one more company. So you have like 5% of the companies, a little bit over 5% of the companies talking about recession. But you can see how this can jump pretty quick in a quarter, right? There was the same thing in 2021, and then 2022, you saw what happened. So we shall see. Want to throw this out there about why Buffett has been buying Oxy. I saw this on Twitter. I thought it was interesting. This is this Manesh Pabri. He was talking about this. He's really a big Munger Buffett fan. And he says here, one time I was talking to Charlie Munger, and he mentioned that he would love to have an investment in Exxon if he could get a commitment from the management that they would do no more CapEx and they would simply run all the oil fields with the cash flows going to the shareholders. He had calculated that it would be a tremendous investment. And of course, oil companies don't think that way. Yeah, they're extractive industries, so they're constantly reinvesting, although some companies do, evidently. Goes on, so, but Oxy thinks that way. If you study Occidental, what you'll find is they don't really have exploration going on. Oxy basically has no speculative drilling going on. So in effect, it looks like a CD. They're clipping coupons. What Oxy is doing is that they have a huge gusher of cash flows coming out, and that huge gusher of cash flows is only going into buybacks and dividends. It's all being pumped out to shareholders, and Warren Buffett loves that. He looks at Oxy as U.S. Treasuries on steroids. And so that's kind of what I've looked at some of these oil companies too. Yes, maintenance CapEx, holding production, but going out and doing big projects or going and doing, exploration drilling and looking for new oil, no, not good. And there are companies that are doing this. And I have a couple in the portfolio that I like. And what are they doing? They're paying down debt. They've made commitments that once they pay down debt to a certain level, they're going to commit ever increasing levels of cash flow to buybacks and dividends. So this is what I like. I'm a Walter Schloss fan, a Buffett and Munger fan. I like cash flow. Earnings can be manipulated. Cash in the bank is what I like. And when it's returned to shareholders, I like those management teams. So this is something similar to what I look for in some of the oil companies that I do have in the portfolio. I thought this was interesting from Jesse Felder. In gold terms, it's priced in gold because gold's a currency, as Ray Dalio says, it competes with the dollar, the yen, the euro. In gold terms, The S&P 500 is exactly where it was in August 1971. The significance of that date is that it was the moment that President Nixon severed the gold's link to gold. So stocks on the gold standard, relative to gold, the S&P is where it was when Bretton Woods was enacted in 1971. Yeah, we did have the big spike during the tech bubble, but you know, you haven't really made any progress in terms of gold. And so a lot of the progress you have made is inflation. And so the government loves inflation. Okay. It loves this being off the gold standard. It hates, the way the world should really work is this. The natural tendency of prices is to slightly go down over time. Why? Innovation, technology, productivity gains. Okay. Things get made cheaper, better, faster. And that's good, right? That's a good thing. Because if you have a wage earner and you're in a slightly disinflationary environment, then your cost of living goes down and the wages that you earn actually are more valuable and allow you to buy more goods. But they have rigged the system, the politicians, because they don't like that environment, because they're restricted in what they can do. They can't fight a war. They can't have a great society program. They actually have to stay on budget, because if they want to spend $200 billion to Ukraine and waste it, or if they want to have an $890 billion defense budget with a bunch of equipment that evidently doesn't work very well, then they have to come to you and say, you have to give us some of your gold or your real money. We have to tax you to pay for this. And no one's going to go for it. And so when they took us off the standard, okay, they were able to financialize the economy. They were able to print money. They were able to run everything on debt and then just, inflate it away. And so that's why you've seen this is a major problem in our economy. I've talked about it 100 times. You have your thing that you're trying to beat is not necessarily the S&P. You've got to stay ahead of inflation. Even a 2% inflation rate is insidious over time. Go into a compounding calculator and put 2% inflation into it over a 40-year working life or a 75 or 80-year life of a human, and see how much the dollar depreciates over that time period. And so now with the debts where they are, these people are going to the result's going to be they're going to go to what they have always gone to throughout time. They're going to steal your money through inflation. They're going to steal your wealth, your time. You're a slave to them. You only have so many days, hours, weeks, months on this earth. And they're just going to extract that from you through inflation. And it's kind of like, heart disease is a silent killer. You don't really know until you have a heart attack that you have heart disease in many cases. And then you just die. Well, that's what they're going to do here. It's the silent way to steal. They're basically enslaving people and stealing your wealth. We're going to slowly but surely get to the point where we're going to see yield curve control, where they're going to force rates down at say the inflation rate will be at like 4%. Long-term treasury rates will be forced down to 3%. I'm just using that as an example. I don't know what these figures will be, but I'm giving you an example. And so the inflation rate will be higher than the interest rate you can get on government bonds. And you'll say, well, I wouldn't buy those because I'm losing 1% a year to inflation. Absolutely. Then they're going to force you to buy them. How are they going to do that? Pension plans will be forced to do it. Insurance companies will be forced to do it. Why? Because the government is the regulatory apparatus and can change the rules. They're going to tell Fidelity and Schwab, everybody that's a 401k holder must hold this percentage of Treasury securities. It's just how it's going to be. Well, that won't happen. It's happened in about 50 countries around the world over time. Yes, it will happen. They need money. Okay? These people are not your friends. They're there to strip mine. And this is why they hate deflation, because the debts collapse in a deflation. They need inflation to get rid of the debt. And there's not one person in 10,000 that seems to even really understand this stuff. And I'm just scratching the surface. I don't even fully understand the machinations. But I know enough to know what they're up to because I know history. And this is why gold has done so well over the last 20 years. People are waking up. This is why gold's flowing from the west to the east, because people know what's people in China and Russia and India and these places. This is why the central banks are increasing their holdings of gold and reducing their holdings of the dollar and treasury securities as reserve assets, because they know what math and history. The question is, do you, listener, know what it is? And so here we have, I got this chart from Martin Prang on Stock Charts. I'm a subscriber. I don't know if I'm allowed to share this, but I did anyways. But you can see the analysis that's being done here. This goes back to like 2020. You can see that the HUI is breaking out. Okay. So this is all positive. Gold's has made new highs recently. This being confirmed by the HUI, the Gold Bugs Index. That doesn't mean every gold stock is worth investing in. I think eventually we probably get a runaway bull market in gold, and it'll be like a hurricane and all turkeys will fly even. But I think if you want to make money in this gold market, you need to concentrate on the companies that are well run, that have their costs under control as best they can, and are benefiting from what's going to happen. And I think this is, going back to 2011, we've had this tremendous kind of, coiled spring, if you will, that we're breaking out of that goes back, 13 years. So again, I'm not super fan of technical analysis, but certain things when you have these long-term periods where you have these breakouts, and again, it depends how you draw the crayon marks on the chart. I know that, I get it, but something's happening in the gold market. Something's going to happen with gold stocks. Think what happened in uranium. That's kind of where we're at, where uranium was 3 or 4 years ago. That's, I believe, the opportunity. This is not a huge market either. And if sufficient capital and liquidity comes into this market, it can fly. Okay, there's no bull market like a gold bull market. This is from Tavi Costa. He's talking about the gold juniors. This is the GDX ETF going back to the same period. And, is this it? Is this the breakout? Well, we'll see. But again, this is confirming what's already happening in the gold bugs index and among several of the gold stocks that I follow, that I have in the portfolio. Is it time to move into the juniors? There are good juniors out there, okay, that I think are going to fly, that have good projects. Again, you have to do the work. You can't just go randomly buy what you hear on, a podcast. You have to understand a little bit about what's going on. If this gold mine that you're talking about buying, they're drilling and it's up in the middle of, the Yukon with no power near it and no roads, probably not the best thing. You want something that is in a good jurisdiction, good management, people that have done it before, they have money, is the infrastructure there? There's a checklist. Okay. You need to make it. There's people out there that, you can research that will give you a checklist. You can think about these things, and you just can't go randomly buying things. You might be better off just buying one of these ETFs if you're not willing or able to do the research. So it's each individual person's going to have to determine that for themselves. But I think something's happening here. And what I like about this right now, no one is hardly talking about this. No one's talking about gold. No one's talking about the miners. You just hear little blurbs here and there. It's not on most people's radar yet. And so we'll see what happens. But I'm becoming increasingly positive, especially as now, as I stated earlier in this particular video, that the U.S. is bringing out the final big bazooka, and we have just about, like I said, virtually, most of the central banks around the world in a rate cutting cycle. Money Fest 2024 continues. So Chinese manufacturers are taking over auto market in China. I just thought this was interesting. The collapse of global brands in China. China car sales percent market share 20 to 2024. So you see, this is in China, of course, but this is starting to happen around the world too. China has zeroed in on the auto market and is now taking aim at it with their manufacturing powerhouse. But this is what you're seeing in China, right? In 2020, Chinese manufacturers had 43% of the market, and now they have 62% of the market. In 4 years, you see Japanese manufacturers are down, German car makers are down, American, Korean, and French are just basically out of the game. So, GM sales, for example, in China will fall from 2.9 million in 2020 to just 1.8 million in 2024. And so, I think that this is a situation, what I've seen, like you've seen in Russia, there's a lot of Chinese cars, a lot of developing markets around the world. You're seeing Chinese manufacturers. And again, I remember like in 1990, in Hawaii, I rented a Hyundai. That's the only thing they had. And this thing was such a piece of junk. I mean, I remember going down the freeway in this thing, and I got it up to like 65, and the whole thing was shaking and rattling. It was a new car. I'm like, this thing's a piece of crap. But now the last couple cars I've had have been Hyundais or SUVs or whatever you want to call them, the Santa Fe's. I think they make a terrific product. I bought a new Santa Fe not too long ago, the calligraphy model. It's got a turbo in it. It's really spacious, leather seats, the whole shebang, and it was relatively cheap. It's kind of a luxe car, and but it performs, and the product, to my mind, I've had great success. The quality is quantum leaps above what it was before. And I think the Chinese are kind of in the similar boat now, right? They're kind of were perceived as junk, but they're getting better and better. I mean, they have some luxe brands. I mean, forget about it. In EVs, they're going to dominate. I mean, they're making it a less than $10,000 EV. I mean, and I suspect that regardless of who's president of the United States, you're going to see tariffs and stuff like that. They're not going to let them pour into the U.S. But then you're going to get these bifurcated markets, right? Because you're just not going to be able to compete with the Chinese when they decide to get into a market. It's just that simple. So, USA, well, we're number one in something, and that's public debt net interest payments as a percent of GDP. We're at 4.6%. So the interest we're paying is equal to 4.6% of our annual GDP. And you remember talking about the pigs, remember back during like the financial crisis and 2009, 10, and 11, they had crisis in like Greece. All the banks went bankrupt in Iceland, Spain, Portugal, all these Mediterranean countries. But you see, like, they were like the ones that were being like castigated and made fun of, and people were criticizing. But look where the U.S. is now. This is another reason why I think Powell's got to cut rates, because this is getting out of control. Congress is not going to stop spending money. And so they have to get rates down. As a matter of fact, if you look at Japan, who's one of the most indebted countries in the world, because their rates are kept so low, the interest payments are only 0.5% of GDP. Now, that's not something to be like happy about, because you saw what happened, the dislocations and disruption was causing the yen carry trade unwind several weeks ago. Going into debt, but it's like people that live like lower middle class people, working people that don't know anything about finance, right? Um, you know, I'm at a point in my life where I can pretty much pay cash for cars when I buy them. And people are like, I'm kind of less like at the dealership. I'm in and out of there. I negotiate everything over the phone and email. I don't go in there and spend 5 hours of my life in the finance manager's office and, hey, what can we do to get you in this car? What payment do you need? And that's what I overhear when I'm in those places. People are subprime, their credit rating stinks, they're in debt, but they got to have a new car. And so they try to figure out a way to get them in something. That's kind of how the U.S. is now. We're a subprime creditor. We're like some emerging market banana republic with these kind of situations. This is another reason in my mind why Powell is feeling he needs to cut rates. This is because the interest payments are just going parabolic because the debt, you're running close to $2 trillion deficits. 1.7 trillion this year, I think, is what the deficit's going to be. You just pile that on the 35 trillion that's there. It just never stops. And if you're running a 5% interest Fed funds rate and you're paying, 5% on T-bills, yeah, that's a problem. And so they need to cut rates to get this down. But does that solve the problem? So you're always dealing with the consequences of bad decisions instead of dealing with the root cause. Okay? Hey, you have cancer in your left lung. We got to cut it out. Okay, cut it out, recover, and go back to smoking unfiltered Luckies so you can blow out the other young lung. That's kind of the mentality here in the U.S. It's not a problem, so I'll just keep doing what I'm doing. Well, eventually it becomes a problem, and then it is the main problem. This is another reason why you got to be in gold. This only ends one way, folks. Only can end in one thing. The only way I would sell gold and become bullish and change my view on the U.S. as disintegrating as a political entity, if we had this magical experience in the Congress, they say, we got to get, somebody calculated the other day, I heard on a podcast, in order to match expenditures with revenue would require cutting spending such that it would be an immediate, in 1 year, 6 to 8% hit to GDP. That would cause revolution in the streets. It would cause a debt to collapse. I mean, it cannot be done at this point. The medicine would kill the patient. The chemotherapy would kill the patient. The cancer would die, so this thing's going to just keep going, putting Band-Aid on top of Band-Aid. This is why you have Vice President Harris talking about price controls. We're going just to attack the consequences of our previous bad decisions. No one's going to address the real issue because if you do, it's not palatable to anyone. So there you go. So here's our hero here. Somebody made this meme. I love it. Communism, Kamala with communism. She's unveils budget-breaking $1.7 trillion economic plan that includes government price controls. She doesn't come up with this stuff. She's got these people that are behind her come up with this stuff. She doesn't know anything about anything. She's a twit. She's a puppet. All these people are. They're not really controlling anything. What I think is funny, though, something's going on here in the Democratic Party because they're almost going to like full Marxism now, right? It's like one guy said, he was on the floor of the convention and all the boxes up there with all the hedge fund people and oligarchy and billionaires. So you've got Oprah Winfrey, who's a billionaire, and Michelle Obama on stage, who's worth about 70 or $100 million herself, and castigating billionaires and wealthy people at the DNC. So I don't know what's going on inside that party, but these are not good policies to pursue. We've talked about it last week. So here's one of the dumb policies that's kind of visualized so you can see the history of capital gains taxes. We've been as high back in Jimmy Carter times as 40%. At least in my lifetime, I was born in 1967. But you can see they've went up and down based on, whatever administration. You see how when Reagan got in, these were cut. Actually, before he got in, but they were cut and maintained at a low level. And it's, you tax if you tax stuff, you get less of it. Okay. If you want to tax capital gains, you're going to get less investment. If you tax cigarettes, you're going to get less smoking. Okay. People are motivated by self-interest and incentives. Show me the incentive and I'll tell you the outcome. If you raise, now assuming they could get this through Congress, there's no guarantee they could do that because we don't know the disposition of the Congress until after the election. But let's say, for example, Vice President Harris is elected president and the Democrats win the House and the Senate, then this will go through and you'll see this, basically go up to 44.6%, the highest in my lifetime. What will that do to investment? Well, it will dissuade people from making investments. And then they're talking about this stupid idea of taxing unrealized gains. Do you understand what that means? Let's say, for example, you buy a stock and it goes from 50 to $100. Let's say you buy 100 shares. It costs you 5,000, and then it goes up to $100 a share. It now went from your total position went from 5,000 to 10,000. Okay. You still don't owe any taxes because you haven't sold anything. You haven't done anything. And if you're a long-term shareholder, if the company business is doing well, you want it to compound wealth over time. When you sell, and then you would incur the capital gain, right? Or loss if it's a loss. Okay. And so what they're proposing, these geniuses, okay, are proposing is if the stock went from 50 to 100 in 1 year and your account went from 5,000 to 10,000, even if you didn't sell the stock, you have to pay the tax on the unrealized gain. Now, where are you going to get the cash for that? If it's 40%, you had a $5,000 gain, you have to pay $2,500. But there's no what if the stock went down? Well, you don't get to claim unrealized losses. This is simple confiscation of wealth. And you're going to see more of these proposals, and the dumber the country gets and the more people that you bring in from the third world, most people don't own stocks. They don't own property. Okay. They don't care. This appeals to them. Envy, resentment. My life isn't where it needs to be. Kamala Harris is going to fix this. She's going to go after the people that I resent and have envy towards. She's going to show them. This is decolonization. Read about what happened in the Soviet Union, in China, and then realize what happens to the general population when all the capitalists leave, when all the investments destroyed. Everybody suffers. But, there's a bell curve on IQ, whether you like it or not. And if the average IQ in the US is 90, it actually went down over time because of the immigration from these other places. Okay. And I don't say this to make disparaging remarks about any type of populations. Okay. I believe everybody has value in the eyes of God, but everybody's not the same. And if you have a bell curve and half the people are below the average IQ, you get down to around an 80 IQ. These are the kind of people that if you put a dime and a nickel together and say, which is more valuable, they'll point at the nickel because it's bigger. They don't have concepts. I mean, time preference, value systems, this all comes into play. But that's a story for another day. But there's because of the inflation, because of the Federal Reserve, because of the oligarchy turning everybody into a Russian serf, these kind of goofy proposals and price controls make sense to people who have no knowledge, no background, don't own anything anyways, and don't care. Somebody's telling them that they're going to make their rent go down and the price of bread and eggs go down. They don't understand supply and demand. They don't understand what price controls do. They don't understand that Kroger has a profit margin of like 1.5%. They don't understand that agricultural markets are highly competitive commodity markets, okay, and that no one single entity dominates them. Therefore, there is no price gouging. This is all mostly caused by the fact that we had a pandemic and the governments of the world shut the world down and then compensated for it by printing a lot of money. And as Milton Friedman said, inflation is always and everywhere a monetary phenomenon. If you increase the money supply by 40%, prices are going to go up. But there's no discussion about that. And the average person on the street, bleacher bum, shoe clerk, has no clue. They're hurting, and I'm empathetic to that. But that means we got to get rid of the Fed. That means we have to disassemble this oligarchy. I don't hear any discussion about that. The apparatchiks at the top, regardless of what happens with the economy, are always going to benefit. It goes back to 1984, man, the pigs. They don't care. They're going to get theirs. And so we already know what happens. Capital goes where it's treated best. Progressive states have lost tax income to taxpayer out migration. Now, it's not the only reason. People don't just leave places because people don't want to leave California. It's a beautiful state. It's probably the best state in the country to live in. You could be at the beach or in the mountains in one day, half a day. There's, agricultural bounty. Okay. There's oil and gas bounty there that they're not allowed to exploit. It's a really terrific place. Okay. I think it's by itself the seventh largest economy in the world. Okay. But you can ruin it with bad policies. We've seen that throughout history, and that's what's happening. People have family ties too. You have friends, family. Well, I don't just want to move from California or New York State and go to Florida where I don't know anybody just because my taxes might be a little lower. But you get to the point, not only taxes, quality of life, what your future is for you and your children. This starts weighing pros and cons, and people make decisions. And this is the facts. This is what's happened. Cumulative gain, loss, and adjusted gross income in billions, 2019 to 2022. Florida is booming. California, New York, Illinois, New Jersey, all basket cases with overregulated, democratic, progressive policies, crime, drug abuse, cities in decline, infrastructure issues, high taxes, high regulation, goofy governments. Of course, people get out for different reasons. And this applies to countries as well. I wanted to show this meme. I mentioned it the other day, and my intrepid Discord readers, one of the guys, one of the people, I shouldn't say guys, I don't know if it's a guy, but one of my folks there, I don't want to use the word followers, fellow travelers. I talked about this meme, and this is in Venezuela. This is the guy I talked about. He's running this bodega before they had all this Marxist, everybody's going to be equally poor, Cuban, Soviet type system of price controls and wrecking the economy. This is what the shelves look like in the guy's bodega. You see he's got a little paunch on him. He's living good. This guy's living the life, right? Doing good. Business is good. Easy life right here. And, 10 years later, well, basically almost 20 years later, after all the policies, well, at least has an icon up here, but there's hardly anything like some cooking oil, and that's it. He's out of business, and he's a lot skinnier, which is probably good for his health, but, not his mental health or financial health. But this is what it is. This is what it is. And this appeals to uneducated people, okay, that don't know any better. And this is why this is, in my view, one of the reasons why the progressives want this peasant population imported here, because once they can get them on the voting rolls, if you don't have anything and you're looking at all these rich people, hey, populists can point at the rich people and say, you're not like them. You're not rich because they're holding you down because of X, Y, and Z, whatever it has to be, typically race, class, whatever they have to say, because it's all about being in power for the politician. These are the worst humans on earth, these politicians. They really are, of both parties. Let's just be honest. These are horrible people. They are. What kind of people want to control other people? It's just, but this is what you end up with. Sociopathic psychopaths running everything with just a lust, an almost like driven demonic lust for power. To do what? To be in charge? Not to make, governments are supposed to be there to help the people's lives to be easier and better, not to be worse, so that they can live in avarice. But, this is what you're going to get as the West continues to decline. Okay, guys, that's it for this week. Again, pretty stoked on uranium. We'll see what happens over the next couple of weeks, especially going into the conference early next month. I'm hoping for some fireworks. We'll see. All right, guys, that's it for this week. We'll talk to you next week. Thank you.